Have you ever taken a loss on a trade, resulting in a bigger dent in your account than you had planned? And you thought to yourself, if only I'd set a stop loss. It's a common error that often causes catastrophic results for many prop traders. So stay tuned to discover how strategic stop loss orders can be your secret weapon for profitable growth. Understanding the role of a stop loss order is crucial for anyone that's serious about trading. That's especially true for those aspiring to thrive in the prop firm environment. So why do stop orders matter so much? Well, first and foremost, stop loss orders are your primary defense against those catastrophic losses. Imagine you're in a trade and suddenly the market moves against you. Without a stop loss, your losses can spiral out of control, wiping out significant portions of your capital. By setting a stop loss, you basically establish a predefined exit point that protects your account from those severe drawdowns. Beyond just preventing big losses, stop loss orders can play a vital role in enhancing your discipline and consistency in your trading strategy. One of the biggest challenges I think that traders face is letting their emotions dictate their decisions. Fear and greed can lead to impulsive actions that make you deviate from your trading plan. Now, with stop loss orders in place, you remove much of this emotional element and helps you keep disciplined. And obviously, a disciplined trader is what you want to be if you want to promote long-term success. Building confidence in your trading strategy is another significant benefit that you'll gain when you're using stop loss orders. When you know that each trade has a safety net, you can approach the market with greater assurance. The confidence that you'll have will allow you to execute your strategy much more effectively, knowing that any potential losses are going to be controlled, and that means they're going to be manageable. And also, stop loss orders helps you maximize profit potential as well by minimizing the risk. By strategically placing these orders, you can lock in profits on winning trades and prevent small losses from becoming those bigger losses that really do dent the account. For example, you can use a trading stop loss that will move with the market, allowing you to keep in the trend for longer, capturing gains as the market moves along with you, protecting you on the downside when indeed the market turns. So incorporating stop loss orders into your trading plan is not just about avoiding those big losses. It's about creating a framework for disciplined and confident trading. Whether you're a seasoned trader or maybe you're just starting off, understanding how to strategically place the stop loss orders can be the difference between growing your capital and experiencing those unnecessary setbacks. At the City Traders, we've seen firsthand how effective stop loss strategies can transform trading outcomes. By safeguarding your capital through smart risk management, you're setting yourself up for sustained success in this challenging world of prop firm trading. Remember, it's not just about making profits, it's about protecting your capital as well, the capital you've worked so hard to gain in the first place. And it also helps you ensure a steady growth over time. So stay with us as we delve deeper into what stop loss orders are, the different types and the like, so that you can implement them more effectively in your trading journey. Let's make sure that you're going to be equipped with the knowledge and the tools to safeguard your trading journey every step of the way. So what is a stop loss order? Well, it's basically defined as an order to buy or indeed sell a trade when it reaches a specific price. Usually they're in place to prevent further loss on the account. That's why it's called a stop loss. We don't want to lose anymore. Basically, think of it as your safety net in the volatile world of trading. The primary goal, remember, is to protect your capital by ensuring that you exit a losing trade before it becomes a significant loss, causing massive dents in the account, which are going to be much harder to recover from. Now, there are different types of stop loss orders that you need to be aware of. Now, the most common one I think that everyone is aware of is the fixed stop loss, where you basically set a specific price or level on the chart where the trade will be closed. Another very useful way of using a stop loss is the trailing stop loss. I often get asked this question: should you trail a stop behind a winning trade? It's a question I think that's on the minds of most traders out there. But it basically does allow you to keep in a trade or a trend if the trend really wants to take off. You know, markets are mostly not trending, but when they do break into trend, those trends can be really powerful. And locking in profits as you go is a great way to maximize your profits on a particular move. And there is another type of stop loss, one that I don't really use too much, but you may see it out there, so maybe it's worth being aware of it. And that's basically the timed stop loss, where you're going to exit a trade after a certain period of time if your target price hasn't been met. Not too sure why people want to use time stop losses, but I know that some people do. Now, understanding key concepts when you're trading, like the risk to reward ratio and position sizing, is crucial when you're using a stop loss. Risk reward basically helps you determine how much you're willing to risk for the potential reward. For example, if you're targeting, say, $100 profit, but you're willing to risk, say, $50, your risk to reward ratio is 2 to 1 or 1 to 2, whichever way you want to look at it. This ratio helps you set realistic stop loss levels that align with your trading goals. And then position sizing allows you to reduce or increase the size of the trade depending how much capital you want to allocate to a particular trade based maybe on percentage risk. So if you're doing your position sizing correctly, you base it on where your stop is going to be, because obviously that's going to be where your maximum loss is. Stop loss orders operate differently under various market conditions. Now, in a trending market, for example, you might place your stop loss just below support level for a long trade, or above resistance if you're in a short trade. Now, in volatile markets, adjusting your stop loss levels based on indicators like the ATR, one of my favorite indicators, average true range, can really help your account be protected in those larger price swings. So if you see an ATR increasing, you may want to increase your stop loss accordingly, so you don't get locked out of the trade just because it's turned volatile. Now, of course, there are common mistakes, and one of the frequent, I'd say, errors that I see out there, traders out there that are basically setting their stop loss just too tight. Remember, you want to place a stop where you don't think you're going to get stopped out. Now, placing a stop too tight can often lead to premature exits from a trade, which would eventually turn into profit. I often hear people complain saying they got stopped out and then the trade just moved back in their previous preferred direction. Now, another pitfall that I often see are those that are placing their stop losses just so far away. And if you're position sizing correctly, it means your trade is going to be so small, even if you get the trade direction right and it moves a few percentage in your way, you're not going to make much of a gain because your trade was just too small in size. That's why it's important that you optimize your stop loss placement to the most efficient place on the charts. Remember, you always want to place a stop where you don't think you're going to get stopped out. But of course, we will get stopped out from time to time. That's what it's all about. And another thing you maybe need to be mindful of is that your stop loss placement should change. Market conditions are changing, so your stop loss placement should change as well. Again, with volatility, if the markets move into volatile periods, your stop loss needs to be adjusted accordingly, still maintaining that position size so that you're not risking more than a predefined percentage of the account. By understanding these concepts and avoiding these common mistakes, you're going to be better equipped to use stop loss orders more effectively. This knowledge forms the backbone of robust risk management strategy, helping you navigate the complexities of trading with greater confidence and, of course, discipline. So let's make this practical with an interactive exercise. So if you have access to a demo account, open it up now, identify a potential trade setup that you find promising, and set a stop loss based on one of the strategies that we've just discussed, perhaps using support and resistance levels, or maybe use the ATR based approach, and monitor how this trade evolves and take note on how effective your stop loss placement is. Don't just do it on one trade, do it on 10, 15, 20 trades to get a real feel on how useful it has been for you. Real world applications really do help solidify your understanding and help you see these concepts in action, not just taking my word for it. By strategically placing and adjusting your stop loss orders, you're not only there to protect your account, but also give yourself an opportunity to maximize those profits more effectively. The stop loss order is going to be the most important order you're ever going to use, I think, in your trading. So let's now look at some examples to help solidify this approach. Okay, so let's take a look at this example using my famous boomerang trend following strategy. Now, for those that don't know, basically a trend is defined when price is making higher highs and indeed higher lows. Now, with the boomerang trend following strategy, we're looking for pullbacks, hence the name boomerang. Waiting for a pullback into a previous higher high in the case of an uptrend, lower low, of course, it was the case of a downtrend. We're waiting for the pullback into the previous higher high, but we have a defined place where we place our stop, and that's going to be just below the higher low that led to that higher high. So for example, you've got a trend moving up here. We create a higher high, we pull back, and indeed we pull back to the previous higher high. That is where you would enter the trade. Now the stop is going to be always just below the previous higher low. So our stop will go in something like here. So we enter there. The stop goes in around there, and profit targets can be where the next level is. So we have a defined place where we're placing our stop each and every time. We're establishing our predetermined percentage risk, and we position size accordingly, because obviously price action is always going to change. And you can see that works here as well. We can just drag this down, and you see this pullback into the previous high, and the stops are going to be there. You can target the next level, and you can move all this up as you go. Another perfect one there. The stops are going to be there. It's a great strategy as well for pullbacks. Another one there with a stop below that previous low. Again, maintaining the same risk on each trade is essential, certainly when you're trading larger capital. Using the ATR, the average true range, great way to factor in your stop relevant to how volatile the market is. An ATR is an indicator you can get on any of the trading platforms. Just go to indicators, find it up there, average true range. I've also put the bands in here as well. So at the moment, this is Australian CAD. The average true range is about 9.5 pips. Well, if you want a 2 ATR stop on your trade, well, a 2 ATR stop would be about 18 pips, and these bands are factored in 2 ATR. You can change that, of course, just by going to the factor of it. 2 ATRs, you can make that 3 ATRs, for example. It just basically widens out the bands. But a clear and defined way where you can factor your stops. As an experimental strategy, why not try this one out? Let me know how you get on. Look for a trendy market on the 4-hour chart, nicely fanned out moving averages. Drill down to the lower time frame chart, maybe the 1 hour, 15 minutes. Wait for a 2 ATR pullback, enter a trade in the direction of the trend, place in a stop, which is 2 ATRs, and place in a profit target, which is 3 ATRs. It's going to give you a positive risk to reward ratio in the direction of the trend. Nothing wrong with that strategy. As I say, let me know your findings. Let's consider using the trailing stop. So basically, you might want to trail behind a moving average. Here's an example. I've got the 8 and the 21 moving averages in. Imagine you have a strategy that gets yourself long around this level when the 8 crossed up through the 21, yourself long for whatever reason, and then you trail behind the 21 moving average, and you're riding the trend all the way up until prices come back down and take you out, keeping the trade for longer. You may have an entry criteria here. Of course, I'm not going into that now. It's all for a different video. But you might have an entry level here, and you're waiting for prices to trade below the 21. Okay, you're stopped out there. Again, you can play with the moving averages to see what works better for your individual strategies. But trailing is a great way to keep in a trend for longer. Bearing in mind you do give some back at the end when, of course, markets do eventually turn. You may want to use a conjunction of trail and static profit targets as well, based on the ATR. Now, as I said a moment ago, it's a big question about trailing and not to trail. Let me know your experiences. Have you used a trailing stop loss approach in the markets? And if you have, please do share me your feedback as well. I'll be interested to know how it works for you. So let's recap the key takeaways from our short discussion today on mastering stop loss orders and why they are crucial for your trading success. First and foremost, stop loss orders are essential in protecting your capital. By setting predefined exit points, locking in a percentage risk on each trade is the way to go. You're going to be safeguarding your trading account against those catastrophic losses, which are particularly hard to recover from. Strategic placement of stop loss orders enhances discipline and consistency in your trading approach. And it's all about discipline and consistency. Now, by removing the emotional element, the fear and greed from your decision processes, you are going to be much more in tune with the market and much more able to make informed decisions without the emotions taking over. We've also covered various types of stop loss orders, such as the fixed stop loss, the trading stop loss, and that time-based stop loss as well that some use. Each type serves as a different purpose and can be employed based on your specific trading objectives and market conditions. Understanding these variations allows you to choose the most appropriate stop loss strategy for any given situation. Key concepts like risk to reward ratio and position sizing, they're integral to effective stop loss placement. Risk reward ratio helps you determine how much you're willing to risk for the potential reward, ensuring that your trades are aligned with your overall risk management strategy. Position sizing ensures that you allocate an appropriate amount of capital based on percentage of the overall account, therefore minimizing risk on each trade. We've explored how stop loss orders function in different market conditions. In trendy markets, maybe placing your stop loss order below support levels or above resistant levels, or swing highs and swing lows. These provide logical exit points in the trade. In volatile market conditions, using indicators like the average true range or the ATR helps set dynamic stop loss levels that basically account for these market fluctuations. We explored the common mistakes to avoid, including setting your stop loss too tight, basically choking off the trade, and failing to adjust them as market conditions change. Now, awareness of these pitfalls ensures that your stop loss strategy remains effective and therefore adaptable. At the City Traders, we emphasize the importance of robust risk management strategies like the stop loss order, possibly the most important order you'll ever place in the markets. Our community has seen firsthand how these techniques can transform your trading outcomes, leading to steady growth and therefore profitability. Now it's time for you to take action. Implement the stop loss strategies that we've discussed in your trading plan today. Protect your capital, enhance your discipline, and maximize your profit potential. Remember, successful trading is not just about making gains, it's about protecting what you've earned and building solid foundations for long-term success. So thank you for joining us on this journey today on mastering the stop loss orders. Stay tuned for more valuable insights and strategies to help elevate your trading game. Watch this video and learn how you can use indicators in placing your stops. So that's about it. I'll see you next time. Stay safe and keep disciplined.